Welcome to the AlphaMind Podcast with Mark Randall and Stephen Goldstein. Before we go into this week's episode, a quick reminder about our podcast sponsor, the wonderful Society of Technical Analysts, the STA, the world's leading organisation for the study and education of people keen to learn more about price action and technical analysis methods. Do check out their website, technicalanalysts.com, to find out more about their services and becoming a member. And also, if you're keen to do their home study course, their brilliant home study course, may I add, into technical analysis, which can also include a technical analysis diploma for a small extra fee, do look at our website, alpha-mind.net, where you can earn a discount on the cost of that program. So once again, technicalanalyst.com for their website, and check out alpha-mind.net to find out how you can get a discount on their brilliant home study course. Now on with this week's podcast.
Welcome to this week's AlphaMind Podcast. We're delighted to have Josh Schuler with us. And we're going to be talking about market profile to some extent. And I think he's developed something that we're quite interested to hear about. A trader since 2009, moved from the retail space into institutional with that global giant, RJ O'Brien. And profile, I'll go back to when I first picked up profile. I was really interested in the fact that you had this sort of Tetris sideways build out of market shape. But in the, I think it was the late 80s when we called it, the Steidelmeier system. Mm-hmm. But then I heard that it that actually may have originated from a runner that worked for Merrill Lynch, who was this Iranian mathematician. And somehow it then ended up in somebody else's hands and became a product. And that rumor turned into facts. I then went to somebody's party in Earls Court in London and met a guy called Shervin, who was an Iranian mathematician that used to work for Merrill's. So yeah, it's an interesting story, but a lovely way of representing the market, I've always found. And so we're delighted to dip into this today and understand what Josh is driving in the space. And I think it is a very, very interesting work. So Josh, welcome to the show, and perhaps just give us a sense as to, okay, we've mentioned sort of beginning 2009 or thereabouts, but what drove you into looking at this methodology of market representation as your go-to place for analysis?
Yeah. Well, first, thanks for having me on. I followed your work for quite some time, and it's an honor to get to have a conversation and get to meet you. And with respect to the market profile, so I think I represent an interesting generation of market participants who were coming into the industry right on the end of a lot of floor trading. The electronic trading was really starting to take off, and you also are on the back end of the great financial crisis, right? So there's this flurry of activity, not unlike what we had after COVID, that's taking place. Is pulling a lot of people into markets, and the access of retail to access markets was at that time higher than ever before. And what are people looking for? They're looking for some approach that works, because anybody who comes into markets, the old adage is the 90-90-90 from a brokerage side, like 90% of self-directed investors lose 90% of the value in 90 days. I don't know. I've never really actually been able to validate that, but you find that people come into markets, especially if they're self-directed, they're retail, they started with some idea. And if that, once that idea is gone, what do they do? And when I started on markets, I started, I came to institutions later. So I started on the retail side. I followed ideas of friends. I didn't know what to do. The absolute vacuum of skill development that exists on the retail side is crushing. Even more so now. There's so many resources out there, but how does anyone vet and know whether they're valid or not? And so I had started with a little run. It was, post financial crisis, everything doubled. So I thought that I had just figured out markets, and then all of that starts to fall away. I don't have the ideas. I don't even know how to create a trade. I don't know what an idea or an opportunity is. And so then if you're going to last, you have to go figure that out. And I was fortunate to I was fortunate early to have a mentor that was one of the first upstairs traders, right? So at the board of trade, you have like the floor traders, and then you have the upstairs traders. And I got connected to her through a colleague that was working at a NGO. He actually used to be the chaplain of NASCAR. So he would have these NASCAR drivers that were his friends. They were all involved in markets. And we had a conversation one day, and he was doing things in markets. I was like, well, Dale, where did you learn any of this stuff? He's like, oh, I learned it from this lady. And he's like, she'll teach anybody that is working for an NGO or a nonprofit. I was like, will she teach me? And I'm like, yeah. Okay. So that was at least some of a framework to get into markets. But what that really taught me was that I wasn't a trader. I was just a clerk. And there's a lot of this out there today where there are people that are just following the ideas of someone else. They unfortunately couldn't cultivate their own ideas. And that doesn't really make one a trader. That makes you clerking someone else's ideas, which also means that you're at risk, because if those ideas go away, then you don't know what to do. That was primarily in stocks and equities. And then she had a colleague, another guy that had run a CTA. It was a short-based fund, but he was a market profile and auction theory guy. And when I was vetting him out, I had met some people at the board of trade and had heard about the market profile, but specifically it was just a different way of looking at the market. But then the thing that unlocked stuff for me a lot was, oh wait, this is an auction. Like once I made the connection that these squiggly lines that we're looking at is an auction process, I was like, wait a second, I know how auctions work. All this tool is doing is it's helping me arrange the price, which is the only indicator that anybody can see or that everyone sees at any time, and helps me organize that around this concept of value. I'm like, okay, that made a lot of sense. And so that was from a practitioner standpoint, that really got me going. But it never, I continued to encounter people who were caught, I think many still are, in this chasm of they're trying to figure out markets, primarily retail, but I even encountered this on institutional people trying to start CTAs and run their own funds, that they never worked for a large firm. They never got to see floor trading. There's just pieces that are missing in the equation of how they approach that. And I saw that because of that, there was suffering that was incurred by that. I mean, there was suffering that I incurred from not understanding that. There was suffering I saw in our clients that was because of that. And so that also said, okay, this has been really helpful for me. How do I help cultivate this for others? Because it just, it doesn't exist. I often will tell kids, because I work with a lot of kids that are trying to figure out markets, and I'll say, man, you're really at an unfortunate disadvantage, because we're at 20 years ago, you could go to Chicago and you could get a visitor's pass and you could spend a couple weeks just watching the floor, and you could figure out how to trade, because you could go, oh, well, like that guy's trading, I will do what he does. Okay, when she's not on the floor, I'm not going to do anything. Well, that guy always loses money. I'm not going to do, like, if you had decent observational skills, you could put something together and you could figure this out. But how does somebody figure that out today? I don't know. It's a really interesting problem, and that's where I've spent a lot of my development work has been trying to build platforms that allow people to access a more rigorous understanding of markets that we would all know and to some degree discount, because that's just how you think about markets. But if you're coming into markets now, how do you find that out? You can't go work for prop firms, like real prop firms. They don't really exist that anymore. There's just very few. It's very challenging. So that's the world that I'm in right now. is trying to crack that code.
Okay, great introduction, and thank you. And I think you're very much talking about the same space that me and Mark engage in, and very much the reason we started this podcast many years ago. We both recognise this rather strange situation where you come into a job and you think, hey, I want to make a lot of money.
Yeah.
And other people are doing it. It looks really easy. and everyone on the internet these days is doing it. It looks really easy. I mean, even it's no different. When I started all those years ago, and maybe Mark, we could hear your story on this. I remember, I was a 20-year-old coming into London, working in a job, and I met these guys on the train who I knew, and they said they started in the city in 1980s, and it's easy. Everyone's making a lot of money there. And what do you do? Oh, it's easy. Someone just shows you what to do.
Yeah,
and you do it. And I'm like, well, I like the sound of that. I'll come along and learn it. And I went into a bank actually, as an institution. What do you do? I'll just do this, do this, do this. Okay, that sounds easy. It looks like they're making money easily. And it's like, it was everyone makes it look easy. And then they gave me my first trading book. It was quite an interesting month. I wasn't trading stocks or equities. I was trading rates on exchange.
Yeah, absolutely.
But I also did a lot of small stocks on the side, penny stocks, because everyone was doing them. Okay. At the time, that's kind of the equivalent of, the
crypto,
with crypto
altcoins stuff.
Yeah. And it was an interesting month because it was October 1987, and it suddenly became not so easy. And everyone had a big wake-up call when the US stock market dropped 50% over the space of one day.
Yeah, unbelievable. I know, what is it? Kalanic at Bank of America, I know he's caught some flack for some of his statements lately, but they've modeled the potential. It's totally a black swan tail risk, but you could have 20% down lock limit days in the S&P. What would that do to people if that happened? I mean, I think it's very highly unlikely, but I mean,
it's always very unlikely.
Very. There's so many incentives to ensure that doesn't happen, but it is possible, right? And
in my time in the markets, not always in the stock markets, but in the various markets I participated in, I've had at least one of these, and the statisticians obviously come out afterwards, and they say that event you happen statistically should only have happened once in the lifetime of 6 universes. And it seems to happen about every 5 or 6 years. And I'm always thinking either the statistics are wrong or we're just really unlucky.
Yeah, or the rule of large numbers changes. Where we live, we don't get a lot of water. It's high desert, but we've had some flood events that have been 100-year floods. So then now what do? You have to build it for 300-year floods. And yet you encounter those. And that's also one of the tricky things that I see people trying to find a way forward in markets where they look at, statistics like that, which measuring market behavior and trying to quantify that is really, really helpful to help you understand and have a reasonable expectation of what the outcomes are likely to be. But again, none of those are guarantees. And that is really challenging for a lot of people because they're like, nope, it should be, it should be set. It should be simple. And you're like, no, I mean, we almost went double neutral in the S&P today, which is, you traverse the initial balance twice. That is like a less than 1% over a rolling 5-year period that we've seen those. I don't think there's one instance that we've seen of those, but it could happen, right? I mean, and then what do you do?
So I guess I'll just go back to what you talked about regarding having the ability to cultivate ideas.
Yeah.
But also, I think, as probably what we would say is that you got to have a mechanism to have a view.
Yeah.
And whether you're a broker, you're a trader, or retail pro, whatever, you need to have a mechanism of being able to apply it to whatever you are viewing, and that product may change. You may decide but you still need to have a mechanism.
Yeah.
So I'm quite, and of course there is this. We're talking about chaos here. Chaos does happen, but of course markets are moving around with not necessarily obvious news controlling them. Mm-hmm. So even more so, you need to have this way of getting your finger on the pulse of it in certainly maybe a consistent, reliable way. So if you look at the comparison between what a lot of people doing, maybe looking at a 15-minute bar, 6-minute Dow, or the MACDs, the RSIs or whatever, and then you're comparing that against what you're doing in a profile sense.
Yeah.
What do you see as the advantages, and why should people look at profile as maybe being a better lens to be understanding the state of a market at any time?
Yeah. So there are a couple things about that, and we'll come back as I want to talk about process as a way to get your arms around the chaos. I mean, so that's a way to mitigate the chaos. But in terms of why I continue to be an evangelist for the profile, so I have a friend here in Colorado, Brian Shannon, who's written a couple wonderful books on technical analysis, and he's widely regarded. But he'll say, we'll go ski, and he's like, hey, only price pays. And it took me a long time to figure out, like, what did he mean by that? But essentially, price is the indicator that every market participant of every capitalization level of every time frame can see at the same time, right? So what does a profile offer? Is it offers me, at least in a day time frame or a multi-day time frame, it allows me to organize that one indicator that every participant is making a decision on so that I can make decisions. How does that stand out? Because it stands out around someone who may be looking at, let's say that they're looking at a 3-minute time frame and they're using, one of the indicators that you described, like an RSI or a MACD or something like that. If they allow themselves to go down the road of believing that that is predictive of something, or that is going to influence some type of behavior, I think that they're short-sighting themselves. Because for that to be true, every market participant would have to be acting off of that same information. And we just know that's not the case. Now, does that mean that those aren't effective tools to use? And people will ask me all the time, like, what indicators should I have on my charts and stuff like that? And I say, I think indicators are like makeup. And they're like, what do you mean? I say, well, how much makeup should someone wear? It depends on your face. I mean, if you need it, dab it on. If those things help you organize the chaos to make decisions, great. But let's make sure that we're parsing them between things that are prescriptive and describing. So if you're saying, oh, well, that RSI is, pegging the needle. Well, what does that describe about the price action that I'm looking at? Do I understand the meaning of that, as opposed to thinking of that as something that takes me into action? In that case, it can be really helpful. So I keep going back and using the profile as a way to get myself to a level of auction participation where I'm mindful of all who may be interacting on that day or on those several days. And if you're looking at just a small time frame, you can miss that very, very easily. So that's the reason that helps me go back. Other is that I'm always and remain fascinated still at the mode reverting aspect of markets, that of all of the manipulation of participation, things that get people sideways, but we always return to a fair price. We always come to some fair price, always. Yeah. And that is fascinating to me. And the number of times that will come. I mean, today I took a short in gold and covered it at exactly the most traded price of the last 5 sessions. Like that's not random, because that's not the first time that's happened. It happens over and over again when you look at stacking things in terms of a daily, weekly, monthly, quarterly timeframes where all of the business happens. So that's why I keep coming back to that. But going back to the idea around process, even if you didn't use market profile, so I get to be in this interesting place. I think you guys are in this place as well, where you're talking to people who are on the retail side and also on the professional institutional side. And, we tend to bifurcate our industry in these two camps, but there's some really distinct cultural aspects of those two camps that are also fascinating. So one is, if I'm doing some discovery around a trader that I may help do some development with, I can immediately assess whether they've had some professional or institutional training or background based on how they describe what the trade is. So if I'm talking to an institutional professional in the space, they will typically talk about they're building the trade based on where they believe or their hypothesis is that price will go. But on the retail side, that is driven primarily on what's happening at price currently, without respect to where it might go. So the ability to have some degree of risk assessment of that is just out the window. And so anyone could be better if they, regardless of the mechanics of how they approach, if they just had good process. And so the process that I use is the only thing that I anybody who wants to be in markets or invest, that I say, if you do this, it's the only thing I'll guarantee will make you better. And it's a process, and it's not unique to me. I'm really think I'm just restating things that have already been said by people wiser and smarter than myself. But we just talk about 4 questions that you have to ask and answer before you enter a trade. And so, the first question is, where's the opportunity or the target? Where do I believe that, based on how things are behaving now in whatever product I am or whatever time frame I am, where do I believe it's going to go? And why? What's the case that I'm building? We do this in almost every other context other than retail traders, right? Any other professional context, people look at, I'm going to invest in my business to do X. Why? Because I believe it'll see this type of return. Or if we invest in this piece, that'll help us get to this upside. So they can do that math. I'm going to buy this real estate because I can get this out of it. But in retail traders come in and that's completely, there's no limit. There's no limit. There's no max. And that creates a whole host of problems. The first of which is, how do I assess risk against that? If I have an idea of where I believe that price is going to go, then now I can say, okay, well, if I believe that that's 100 points away, can I find a spot or a triggering behavior that will allow me to get in and keep my risk, at 1 to 3, at a minimum, or 1 to 5. So I'm getting asymmetric bets as I'm going in there. I don't have to be right every time if that happens. So it's, what's the opportunity? That's first. The second is, what would I risk for that opportunity? The third question is, okay, once I pull the trigger, how will I know that I'm right? I mean, because at the end of the day, all of us as market participants or investors are storytellers. Like, we are taking action because we're writing a story of how we think things will go. So that means we should have a picture in our head of how that's going to go. What is that picture? And as we get in that and go along, is it following along in the way that we thought it was? That can help us retain the conviction to get towards that target. And then the fourth question is, what shouldn't happen? What would tell me that I made the wrong call and I should get back to the sidelines, or I should cut my losses, or get out? And that doesn't mean that I take even my full risk. Sometimes it'll be, this playbook trade should come out. Typically it happens within the first hour of the day, let's say. And if I'm 2 hours in and I'm still not, that should be a warning sign, because part of the equation was that it would be there in the first hour, and it's violating that. So using those 4 questions does a whole host of things. One, it raises, especially the retail trader, it raises them out of this idea of being driven by the trigger or the emotion of what's happening. It gives them a little more process to organize the chaos and say, here's where I believe it's going to go. Here's what I risk for that. Here's what would tell me that I'm right. Here's how I know that I'm wrong. And then if I don't have an answer to those 4 questions, I don't pull the trigger. That's a great process. And we use that a lot within the profile. I think what's helpful about like a market profile is that there are repeating structures that make it easier for people to identify when conditions to act maybe in play, and then they could run through that rubric and make better decisions. But it's remarkable to me how little process there is on the retail side for that. How often I talk to, institutional professional colleagues who they just know that like risk is first and foremost. When I was running a managed desk at RJO, I mean, the risk manager sees every trade that I place, and if they're like, well, okay, you've got $1 million in margin on that, do we know why we're doing that? Like, what do we stand to gain out of this risk, right? Do we have a hypothesis around that? Those are things that are just pay to play in the institutional professional space that are just nowhere on people's radars on the retail side. So a lot of my work is trying to bring that to those who would like to participate.
We will return to this podcast shortly. Just a quick reminder about our podcast sponsor, the Society of Technical Analysts, a brilliant organisation which help traders and analysts from across the spectrum of markets. They have many fantastic programs, including the new Technical to Trading System program. Also, do check out their brilliant home study course, and AlphaMind listeners can get a discount on that. Just go to our website, alpha-mind.net, to find out more about that. You can find out more about the Society of Technical Analysts by going to their website, technicalanalysts.com. Now back to the podcast.
One of the things I recall, I think was a great indicator of using profile. And of course, I understand now that profile has gone slightly out of favor with a lot of people. I think some of it because it's behind a paywall and it costs a bit to get access.
Yeah.
But certainly when, it may well be worth paying for that access because you get a sense of the shape of volume per price. So there's a volume shape as well as a price shape. And they're not necessarily the same thing. But they can be very indicative of understanding that we're peaking on low volume. I guess it's accessing the liquidity data bank of the Merck, to determine those things. So it's real data, right? So it's using real data, and I guess that's why you have to pay for it. That shows you a sort of a flavor of the personality of the day by showing you a volume shape.
Distribution.
Price distribution. And I found that very, very intriguing to be able to, certainly when I was from a broking sense, you can have very good discussions around what that might mean in terms of if this is a sustainable move. It gave you evidence base that this may not sustain because there's no volume behind the move.
Yeah.
And I think it is a real eye opener. So how does it interact with terms of your product? Are you providing the mechanism for someone to see the profile, or are you commenting upon what's evolving in the profile you see?
Yeah. Well, when I work with traders, I mean, the platforms to execute, and I try to be platform agnostic. So if somebody wants to use a platform that you have access to. There actually have been a dearth of new platforms that have been bringing true market profile, which is TPO charts, in addition to volume profile. I'm seeing that as more of a standard feature. Even Robinhood, of all places, has volume profile now as a standard indicator. I still use both. And I also get in this conversation around what's more important: time at a price versus volume at a price. And I would argue volume at a price. I mean, you mentioned the liquidity data bank, which most people aren't aware of if they got started after I did, because there wasn't live data, there wasn't live volume, so you use time as an approximation for volume. Now we can get that in real time. So what is more important? I would argue it's the volume. However, the time allows us to see structure and order the day. And what's great about humans. Like Richard Thaler in behavioral finance and Kahneman's work. I mean, the idea of humans being predictably irrational, but we behave in these patterns, namely that they're expressed in how auctions work. So ordering a day in terms of an open type or a day type. I mean, there's 5 open types, 7 day types that we look at. Rarely textbook examples, but there's consistent characteristics around that's someone can learn that, and that can go, okay, well, if I can identify that this is the open type, that means that I've eliminated some of the potentials of what will happen next, and it helps me focus my attention in one way. So I spent a lot of work just helping translate that information to a trader, because you can still get great books that are out there that talk about auction theory, but being able to see it in real time as how it's developing and articulating that. I mean, when you're in the vacuum of self-directed development, it's really challenging. But then the other piece, and this goes back to something, Stephen, that you said at the top about you went to go work at this desk and they said, do this, right? Like, do this. So I think it's 23. So I have long had this out there that if anybody who's trying to figure out markets and they're just, I'm convinced everybody needs a leg up at some point. And so if somebody's trying to figure out, I put aside several blocks of 20 minutes every week that anybody can schedule, and we'll just have a conversation. Like, it's no charge. Just like, if I can help you, that'd be great. I think at 23, I did 253 of those conversations. And one of the things that I'd ask is, what's your trade? And now the large bulk of those conversations were all retail. No one could answer that. They didn't have a trade. So like when you went to that desk, when I'm imagining that they said, hey, do this. When they said do this, they meant like, here's the thing that you're looking for. And when this happens, you're going to do this. And then and it should do this. And if it does this, then do that. Like, that whole thing is built for you. And that becomes a substrate that then you could practice. And then as you got better with that, you could iterate and improve, which is how we do development in every other industry, but retail trading. Right. Well, every other industry, we apprentice people. We don't just like throw them to the wolves and say, well, you figure it out.
Well, here's my thing. And there was something I wanted to ask you in my mind. I'm going to come back to this, and this is for both you and Mark. Okay. But you are correct. We've spoken about this a lot in the past, where we say, trading is a highly skilled activity. And it also occurs within a very complex world. Mm-hmm. Okay. And in order to do something really skilled well, you talked about Formula One motor racing at the very beginning of this.
Yeah.
Okay. For you to be able to get to that level, even for Formula 2, or was it Formula 3? And you would have to have been driving a car for something probably close to a decade.
Yeah.
And you're not just learning the mechanics of the car and the way the engine works and the way the track works. You're out there almost every day, or at least every week, several times a week. Yeah. Just going through it, just practicing, just developing a feel for it and an understanding of it. It's the same if you want to learn golf at a top level, or you want to play guitar at a top level. Okay.
Yeah.
It's going to take many years to reach that point where you're in that very small, if you think of it like a pyramid going up, only the people in that very top and near the apex of the pyramid get to achieve the high levels. They get to race at a high formula level. They get to compete in golf at a high level, let alone win it. Just to compete, get into that top world in tennis, or, get into that top 100 makes you, to be one of the top best 100 tennis players or golfers in the world. That's tens of millions of people who started out at the same time as you.
Yeah.
You've got to. How good do you have to be?
Right.
Golf is a great example of the handicap system.
Mm-hmm. Mm-hmm.
Okay. Getting to perhaps a 10 handicap, you can do maybe in a couple of years. But getting from a 10 to a 2 probably takes another 5. Mm-hmm. And a 2 just makes you a very good player locally, amateur-wise. It doesn't get you any near the professional circuit. You've got to be through scratch on the other side, and then you're starting to look. Yeah. And it's the same in trading. Trading is a highly skilled activity. Mm-hmm. Okay? Whatever trading you do, whatever style, whether you're retail, whether you're professional, and it's ever changing, it's ever evolving, it's ever shifting. You've got to be adaptable. And you learn, like you said, I call it the being pushed in the water bit to start with. You go in the water and you learn to swim. Mm-hmm. And if you can at least keep your head above the water, there's your first bit. Yeah. Okay. But that's not getting you to the Olympics. Okay. Right. Yeah. That's going in the pool every day, being tutored, learning, being trained for multiple years, 5 to 10 years. Okay. Yeah. You want to be one of those guys. And I work with some of those guys, some retail traders who make proper money, 7-figure money. Guys who are under the radar. They're not well known.
Right.
Okay. All right.
Which is fine for them. They're happy with it.
They don't care. They don't want to be on social media or whatever. They're just some of the, you can do it as a retail trader, but I know their journey. I know how long it's taken. Yeah. If people knew about them, they'd think, wow, that guy's an overnight success. No, it took years to get to that level.
Yeah. Okay. It is an interesting, like that conversation that reminds me of the 10,000 hours discussion, so that's 10,000 hours to become the best in a highly competitive area. However, to have decent competence, it takes 20 hours. And that's a place that I spend a lot of my thinking around is, okay, so how do I build the structure to get the best 0 to, it's the Pareto principle, right? How can I get, 80% there and 20% of the effort? With a structured approach, you can actually get quite a lot of competence really quickly. It's honing it that takes all of the 10,000 hours to where you're just where you, I mean, so many of the trades that I take, I'll have somebody in my office and they're like, well, why'd you take that? And I mean, it's all process. It's instinctive. And I'm in the support group of other traders that we talk a lot about instinct, but it's not instinct that just came because we just naturally had this instinct. Like it was a cultivated and honed instinct that now we can access because we're operating at that stage 4 type of competency. But that it started with, a process. What I'm encountering so much currently is young people who don't even have a structure within that first 20 hours. So then that legs out to 3 years to 5 years, and they still don't know what they're doing. And then I think this is one of the places where this industry is unique and distinct from others. And I would go to like John Coates' work, the hour between the dog and wolf, when he talks about how the human brain is around risk. It's even why we use have those 4 questions. I've had a couple conversations with Denise Scholl about just priming the brain, because there's something about the human brain and the risk connection that doesn't exist at the same degree in other industries that can really throw this whole development process off. That part's unique. All the other pieces are the same, but if there's not a somewhat structured place early on, more time typically doesn't work. I'm curious, like of those that you've worked with that have been 10 years out, like how many of them started like they were just trying to find a way as a retail trader, or did they have some institutional structured background first? And then you helped on that?
This brings me to one of the other questions I wanted to ask you, because you and Mark are in quite a unique position. Okay. Yeah. And obviously you're familiar with Tom Hugard. He was in the same position as you, and this is where I'm going. And one of my very successful retail traders was also in that position, and that they were brokers. And I know Tom saw this, and my clients saw this, in that just having a window on what everyone else was doing and seeing that about 99% of them were failing. Yeah. Despite having all the information. Okay. Yeah. And watching that small 1% who were doing something right was for him really powerful. Yeah. And he made notes over many years as a broker and looked into things and really got a sense of, okay, so I don't want to be doing that. I want to be doing that. I want to be doing what the 1% are doing, not what the 19. I definitely don't want to be doing what the 99% are doing. Right. Okay. And Tom Hugard went down the same route. Hence his best loser wins. And we always say that, a lot of the brilliant traders I've worked with are, institutional as well. They're great risk managers, and that's part of their process. It's not the only thing. Obviously, they need to find a way to take risk, which is what a system like Market Profile is so brilliant for people trading on their own, doing stuff at home in the short-term market. Yeah. Where you don't have the same sort of leverage as institutional guys. Okay, so you've got to be in and out quickly. But to what degree did being on the inside, and I know, Mark, we've spoken about this before, so I'd love to hear your view as well, but being on the inside of that world and seeing what people are doing, and so how did that inform you? How did that help you? What did that enable you to see?
So I've talked to my friend. So Anthony Credelli, I don't know if you know Anthony.
Yeah, he's been on a couple of
times. We've talked about it. What a gift that was. I mean, when I was at RGO, so we had this platform that, all the orders come through, and the FCM is, and I worked for a GIB, so we were an introducing broker directly into RGO. So it was only RGO orders, but every trade, there was a cash register that went off to let you know that a trade went, because that was revenue to the firm. But I could always map the product to who the trader was. And that was a number of things that I immediately learned that were questions in my brain before I was able to see that. One was the idea that size makes right. That's just not true. I was given one time, by the principal in our office, a client that had bought the literal living 20-year top of Minnesota hard red wheat, like 20 contracts, and they were down $500,000 on this position, and we were trying to pull them, and it was their position that they made. They got caught up in it, and like, here was a big position, a lot of capital in this position, but there was no process other than they were just chasing it like anybody else chasing something else, right? So you see the idea that size is the other thing that you see, because, and I think this was unique to being in a primarily agricultural producing serving brokerage, is that you'd see size come in, you're like, oh, but that size is a hedge. Like that was a position that was literally put against physical. So, someone who's just looking at order flows coming in might go, oh, well, that means, everybody's getting short. You're like, no, they're already long the cattle. they're locking in profits. That doesn't mean that they're short anything.
Yeah.
Which that was fascinating. The insight that there weren't any magic pills, right? I mean, even with AI out there, I'm not hearing stories of some fund that is just, has a massive 95% win rate and is just printing money like an ATM. Like that, there's no special tools or frameworks in execution that are just going to make it easy. Doesn't mean that there aren't better ones, but it just means that there aren't like these magic silver bullets. That was really, really helpful and insightful. And then, thinking about everything in terms of risk, like what was the risk relative to that? We uniquely worked within like our branch office. We did a lot of agricultural hedging. And so we were actually doing cross currency hedging, because we had some Canadian cattle producers. So we were thinking about things in terms of, how much percent exposure that they had. And those were all trading positions, whether it was in the loonie or it was in live cattle, or we were running a reverse crush and we're doing multiple contracts around things, but it was all ways to express risk, which, I mean, ask anybody who opens a brokerage account if they like those terms of expressing risk are just not in their vernacular at all. So being able to, part of what, when I ultimately left to do more development work, came from having relationships with the clients who I actually came to care for. I mean, they're great people. They were really wonderful humans. And I would see them make these just really dumb trades because I could see them all.
I was doing dumb trades after 20 years.
Yeah. Let's be clear. I still do dumb trades, right? But, yeah. But I would see just routine, this lack of process. And it was in my face every day. And other brokers within our firm that were making recommendations or given advice based on a question from a client, that were just without process. And I was like, man, this whole thing needs more process, because if the entire ecosystem of markets has more process, I just think everyone does better.
Yeah, it's an interesting space, right? Of course, there's, with Chinese walls and the protection from information, there is no internal advantage anymore. That's just right. You just can't be propping on the back of somebody else's flow, no matter what it is, even if it is. Even if it is a hedge, and I think
they're trying. It's fascinating. I've seen even in the current space, it's all gamma exposure. So there are more and more tools coming out where, especially these young kids, are trying to track gamma in different expirations of options to discern where price is going to go and whether expressing it in 0 DTE. But it's the same thing. There's this edge that exists right now. They don't know what will happen if it goes away, because there's not a fundamental understanding of the framework underneath of it. But yeah, that desire to go chase something like that, whether it was that or the SOS bandits back in the day, there's always that desire. what's interesting right now. So 2 projects that I'm working on currently. So I love market profile, but still the same problem around market profile is that people don't know what the trade is. So we've developed a platform that essentially I'm just giving traders my playbook, and it signals when the driving input of that trade is in play, and then they can make discretion around that. So it's at least leveling the floor of what to pay attention to. And then I have a dashboard, and I can see the users executing on these. And we'll roll it up into analytics to ultimately give feedback back to the users to help them be better traders. But I'm doing this in 2 spaces. I'm doing that as future traders, but also in the retail retirement investing space. There's this whole group of investors that started after 2020 that came to markets, and they're a different demographic than ever before. They're young, they're diverse in age, gender, race. There's more access to markets than ever before, but there's even less access to skill. And these are kids that are facing things like, here in the United States, if they want to retire and they've got 35-year runway, the number is what you need $3 million to have a quote unquote comfortable retirement. And using the playbook that their parents have, or that they're being taught to go back into, they would need about $23K saved/invested every year for 35 years to get to that number. And that's at a time when half of Americans don't have $500 for an emergency. Well, you could do wild things about this if you just crank the yield, right? And how could you crank the yield? You could crank the yield. You just have to get into a different playbook. Well, what playbook is there that's out there? So we've developed a platform that's using multi-leg options, which are complex option trades, which we know those they're not exotic to anybody who's been in the industry for a number of years, but for somebody who's in the retail side, trying to discern what strategy to apply to what stock, how to build that, and even how to execute on that is challenging. And then also how to allocate the risk. So all of this is within a platform where we're taking people who would otherwise be in a 401k or an IRA, and they're executing complex options to try to move the yield. And that to me, just putting my own thing. Yeah. It sounds scary. I'm not being funny, but yeah. It's guys playing with dynamite. It can be. It certainly could be. Don't know how to handle dynamite. Yeah. Playing with dynamite, and it might not blow up on their hands a lot. Yeah. But when it does, it only has to blow up once. Yeah. So there's things that we do around that. Like we don't do anything that's undefined. Right. Everything's defined risk. So there's no unlimited risk. So we're not selling any strangles, but you could do it as a condor, and you can be really capital efficient, and you can have defined risk around it. Or you can buy a call butterfly. It's a debit spread. It's a defined risk. But that's one piece, right? The other piece is the skill. And so giving them feedback on how they're doing this. And this is for a generation this is a generation that was trying to do the GameStop stuff, right? So they're willing to go after something more exotic, but at the same time, I see all the order flows. I see how they're performing, and it's giving me insight into how anybody who's on the retail side is trying to interact with these things. What things do they not know? Which is still, I understand that the curse of knowledge is a thing, but it's still remarkable to me how little people on the retail side of this business understand about the whole business. Well, it's one of the things I tend to say to retail, and I have seen this in action, is just to keep it really simple, because the pros out there, the guys in the sales side, the guys in the hedge funds, okay, they're making money from everyone else messing up in a way. Yeah, so if you're a broker and you're seeing everyone messing up, which might be some of those guys on the sales side who are doing stuff with you, but they're making markets. They're like the casino. They're collecting, and they just need lots of suckers. Okay. Yep. All right, and it's a brutal thing to say, but your job is not to be one of those suckers. Not to overtrade.
not to not have a process. They want you
They
to
do
not
process.
have a process.
Exactly.
That's what they want. It's almost like you've got to think, well, what would they like me to do? Well, they'd like me to not have a process. They'd like me to overtrade. They'd like me to panic.
Yep.
They'd like me to oversize. Okay.
Yep.
They'd like me to undersize, so I end up oversizing. Okay.
Right.
You know, they want me to be outcome focused and really chase the P&L. Okay?
Absolutely. Do you think that there's a divergence there between the hedge fund operator versus the broker?
What do you mean?
In terms of their desire for the outcome of the mass, right? Because like the hedge fund participant they want the mispriced information because that is opportunity for them. The brokerage side of the business, which is a transactional side of the business, struggles when there's not process in all participants. Like a broker doesn't make any more money if a hedge fund kills it versus a hedge fund doesn't do well.
Right. So I'm just sort of separating those three out.
Yeah.
You got the sell side, which collects on liquidity. That's where the sell side make their money, at the liquidity end of the market. The hedge funds. The hedge funds is a really interesting space. Okay, I think in a way there's a little bit of how can I say, we've seen this in the commodity space this year, or in the last couple of years, where hedge funds go through cycles. Okay, they see a market making a lot of money on the sell side or on the commodity trading side, on the physical side. Yeah. And I think, hey, there's a lot of money to be made there if we leverage that with capital.
Yeah.
And the hedge funds go after it. And they're very good at doing that. To me, the great hedge funds are brilliant at risk management. That's what they do. They get some smart guys who understand how the market works. We'll give them capital and we'll risk manage them.
Yeah.
That's, to me, Ken Griffin, that guy, he's really a genius, understands the market, but he understands risk management as well, the importance of it. Okay. Yeah. Get a lot of clever guys in who really understand the market, who've sat in sell side seats over many years, who can find the value out there and then put a lot of leverage capital into it. Okay.
Yeah.
The brokers, I don't know where you talk about type brokers, where in the UK here we talk about brokers really as the people who sit between the orders.
Yeah.
Okay, whereas the sell side is really the market makers.
Right.
Yeah, and they've all got their own bit of the money. The market makers are, again, they're trying to get a lot of flow in, and they're trying to hedge that risk, and they're trying to use some of that flow to leverage direction a bit as well. And there's different periods when they all do well. They all like volatility, usually. Yeah.
My sense is that the sell side has done really, really well as we've moved more towards zero DTE.
Right.
Because that is far easier to hedge that off than the longer dated stuff.
Right. Is there a lot of people out there doing that?
As on the sell side, or just trying to participate in those expirations?
Trying to participate in those expirations.
70% of all the options written today are in the expiration of today.
Yeah.
Right.
Yeah.
I mean, it is where, I mean, like the kids, like we talk about the kids, right? These young kids are trying to be markets. Like they're all doing zero DTE stuff.
Okay. So a new product comes along usually when someone can make money market making it.
Yeah. Which then the market makers are making it, and it's really wonderful for hedge funds because it's a very great and efficient priced hedge vehicle, right? Because no longer do I have to hedge 30-day risk around one event. I can do just that one event, which is a remarkable thing. But it's the part that I think about even within this space, and it's I think it's also unique to the United States because we don't have a real social system. So, and we've deputized the S&P 500 to be everyone's retirement. But I look at a firm like Robinhood, who had 20.5 million daily active logins in 2020. they now have those same number of accounts. Maybe have added 3 million accounts or so forth, but they have half of those that log in every day, and their revenue. So they get revenue from Citadel. They get payment for order flow from Citadel, and if you look at the revenue that's there, it's in buckets: stocks, cryptos, and options. Stocks and crypto are 5x the number of transactions as options, but options makes as much revenue as the other two combined.
Wow.
And it makes sense because it's the spread's wider.
So market makers win. So the job
market makers win on that. Yeah.
The job of the trader
business wins.
is to not be the guy that the market makers like. The market makers love you if you do loads and loads of volume.
Yeah,
that's right.
Brokers, when I was a trader, my brokers, they didn't hate me because I got on really well. Okay, with
Just keep doing condors, Steve.
They were always trying to get me to do butterflies and condors every day. My mate.
Have you seen this guy, the SPX, that does condors every day?
No.
And this will date this podcast, right? Because at some point he's going to get blown out. But there's this group that they go and they sell an iron condor in the SPX every day, and it's like 99th percentile strike volume. Like I have a model that I can actually look at, and I can see the open interest on the GEX, and you can just see him. You can just see his wings out there. And at first he was doing really well. Now there's a market making algo that's hunting those strikes, right? Because they're seeing. I mean, it's transparent. You can see it.
I used to walk in every day, and Justin, my broker, used to go. He used to give me a run through the flies every single morning. I'm like. At some point, I've gone, Justin, your boss is telling you have to do this, don't you? I'm not saying a word, Steve.
I share some concern that Steve talked about dynamite in terms of the option side and retail entry, not the world of options, without significant education and protection. I think that I think the formula of 1990 and 90 gets shifted to 1990 and 10 if people start shifting into the world of options without any clue about the 5-dimensional, what can suddenly move without price actually moving, right? And it gets very scary. And certainly in the pro world, I would say that very, very few have got their hands on the landscape of volatility and are understanding at the point where it's a nice bread and butter business. I think they all have significant challenges, and certainly the risk managers, if they're going to be breathing down anybody's neck, it's going to be just paying very close attention to the dynamics of an options portfolio. So I kind of share Steve's stick a dynamite reflection on that. But let's go back to profile. So we talked about. You mentioned that one of the drawbacks to profile was the question of, well, what do I do?
Yeah.
And that you were then looking at this other layer of facility, I guess.
Yeah.
That tells people what to do based upon profile, is it? Or is it some other extension of it? Tell us briefly about that.
So for example, one would be, we know what a trend day is.
Yeah.
All right. We can identify that in a market profile graphic. So we have a playbook trade that's a day after trend. And now it's definitely not as effective as it was because of zero DTE options and its impact on markets. But historically, you could go home if you had a trend day higher. You could go home long as a futures trader and expect that you would see higher RTH prices the next day. You would at least see some excursion in the direction of the trend as a follow-on. So like the platform will identify any futures product that had a prior day that was a trend day, and then it's calling on their radar of like, hey, as long as we're not through halfway back on the open of this, we're looking for a trigger in the direction of the trend, as we, carry on and accept that. So that'd be one. Another one would be an initial balance break. So we have an algo that measures relative widths of initial balance to a product over different periods of look back, and would say, okay, if we break the initial balance, we've still got 50% of the expected range that's out in front of us. There's a really good chance and probability that we're going to see some excursion toward, say 50% extension or a GEX level or something like that. And so that gives someone a target. It tells them, hey, as long as I'm outside of the initial balance, I'm on this risk. If I spend too much time inside the initial balance, I want out of it. But what the platform does is it just signals based on just a TPO graphic. And then, it has different layers of confidence factors that they can then weigh, and then they can pull the trigger discretionarily, but then they can log that and then, look back and use that. But they're tuning it based on at least a substrate. And it's encouraging them to look, one, for structure within the profile, which they can identify. You don't have to have a whole lot of skill to be able to go, oh, that's an open auction in range, or that's an open drive, or that's an open test drive, or this is a normal day, or this is a trend day. Like, they can identify those things, which then says, oh, this is how it's behaving, what's the most likely behavior next, and tease that up to just help them build a playbook, because they just don't have one. So it's all the TPO charts.
Interesting.
Yeah.
Do you know, I'm mindful? A couple of things happening here. One, I'm already thinking about what title we're going to be.
Yeah, it's because we've been all over the place.
Because this podcast has gone all over the place. We've had process. We've had, interesting stuff for beginners that, I wish they could really think about some of the stuff that you're talking about here. Yeah. Because, the only thing that you have when you're a trader keeping you between success and failure is process.
Absolutely.
Without process, you've got nothing.
Yep.
Okay. And if you haven't got a process, you better find one, or you at least start with one. Yeah. And then you've got to learn to stick to it and evolve it and adapt it and develop it and apply it.
Yeah. I mean, that's
there's a lot there. There's a lot there. But anyway, of course, we talked about market profile.
Yeah.
Which is, it's not something I used, but I remember going into, prop trading firms back in the day when they existed. There's still a couple around. Obviously, Mike Bellafiore's got his run in New York, but there's not that many left.
Right.
And there'd be banks of screens with guys doing market profile, which we never had when I was in a bank. Yeah. I was in an investment bank. No one really looked at market profile there. It's more of it's a brilliant tool for short-term traders. People really trading the liquidity and the volume and the noise that goes on intraday. So it's a fantastic tool for that. That was my feeling.
Yeah.
And then we've kind of gone into, some of these other areas that sort of sit in between. What are people doing in the sell side, the buy side? So it's been a very broad, deep, and it's what we love, just sort of shooting the breeze, really.
The tie back on, I think, all of it is just the fascination with human behavior.
Yeah.
And the incentives around those that exist in markets, right?
Okay.
And raising people's awareness to these sometimes agreeing and sometimes competing incentives that will lead to outcomes. And I mean, you're absolutely right. And I mean, even going to your book, which that the mental part of this stuff is so key, but it's built on the backs of a solid process. And if nobody got anything else from what I shared, if those 4 questions is just a simple process to be able to.
Well, it's interesting because when I go back to, what was that kernel of that book that I wrote, Mastering the Mental Game of Trading? It was probably about 30 plus years ago when I'd moved away from a market making role inside a bank into more of a prop trading role. And in a market making role, you do get volume and other people's orders to trade off, and they give you the triggers for trades. Yeah. Now I had to take trades without any triggers, and I'm like, geez, how do you do this? Sure, you can have a technical analysis, you can have a breakout, it's in here. The game is in here. We're doing this without video, so we can see each other, but I'm pointing to my head, my fingers to my head. That's where the game is.
That's where the game is.
You can have all the best data, all the best tools, all the best news. You can have a great system. You can even have a great process. But if you can't bring them to the table with yourself at the same time and win that game inside your head, you ain't winning anything. And you can have not everything and win the game because it's so much in your head as well.
Isn't it remarkable that if the longer someone lasts in markets, this is the place that we all go to?
Yeah.
Well, like whatever the specific way that we executed or approached it, but the place that we go back to is yeah, the biggest obstacle to whatever outcome I'm looking for is between my ears.
Yeah. The old golf quote there, Mark.
Yeah. And it's on the golf course or driving F1 but in markets, absolutely. It's a remarkable, man, it's so remarkable to be humans.
So there we are.
So there we are.
We do have to bring this to a close.
Yep.
Gone on slightly longer than we thought. But it's a great chat. It's been a great chat. It's meandered in lots of places. Hopefully there's a little bit in there for everyone. Can we just get you, Josh, telling us where they can find out more about you? And we'll make sure this is in the show notes.
Yeah. So two platforms that I would direct you to. One is signalp.ai. So that's a playbook platform that we've built around the profile that we've actually just released. But it's for primarily for those that would want to learn how to build a playbook, or if someone asked them the question of like, what is their trade? And they were like, I don't know. It's a great place to start. And then if someone isn't scared off by the idea of options, miflo.com. So MIIFLO.com is this crazy experiment that we're trying to do to get the next generation of investors using complex options as a way to grow into retirement wealth. But it's fascinating. All of those platforms all use auction theory. They all use, which is all auction theory is just trying to map humans, right? We're just trying to make decisions around risk based on how humans behave, and that's a fun game.
That's what trading is.
That's what trading is.
That's how
what investing is, right?
Yeah. Okay, brilliant. Mark, do you want to just sort of maybe just bring this to a close?
Yeah, I'm just very, very grateful for Josh being so frank with everything and taking us on a wild journey through 2009 onwards, right? I mean, relatively fresh to the market compared to us lot. So we're keen to hear these new ideas, and of course, they've been around for a while. But of course, retail traders particularly need to know that there's a broad reach of stuff rather than just pure futures trading. So there's stuff to be explored with caution, of course. And as we mentioned, there's typically the 90-90-90 rule, but that can change significantly, and certainly the ability to hang on to your money is something that a lot of people want to be doing, but find that difficult pretty quickly. So I think we need to throw out a degree of caution with what people are doing. But nonetheless, I've always liked market profile as a methodology. It's a very interesting lens to at least confirm other views that you might have. So we're grateful for Josh to reinvigorating that conversation today, and wish him well on his journey. So thanks for being a great guest, Josh.
Oh, thanks, gentlemen. Absolute pleasure.
Thank you for joining us this week. We do hope you enjoyed the episode. If you want to know any more about AlphaMind and our services, please do check us out, alpha-mind.net. Thank you to our podcast sponsor, the Society of Technical Analysts, the STA. You can check them out at technicalanalysts.com. And as a reminder, listeners to this podcast can obtain a small discount on their brilliant home study course. You can find out more about that on our website, alpha-mind.net. We look forward to you joining us for future episodes, or do feel free to check out our past back catalogue of episodes on the AlphaMind Podcast.com. Have a good week.